So hello everyone and welcome to this brand new episode of the Investors Podcast video interviews. So I'm really excited to have Jack Vogel on the podcast today and doing this interview with him because Jack is really a guy you should pay close attention to. He has a PhD in finance and a master in mathematics from Drexel University. He's also the CFO at Alpha Architect and he is also the co-author of a brand new book. So perhaps, Jack, before we start the interview, you can just briefly talk about your new book and what you have especially been focusing on in your new book.
Thanks, Stig, and thanks again for the opportunity to be on here. So in our new book, which is titled DIY Financial Advisor, we hope to, we come across a ton of DIY investors who at times like to manage their own money. So the way we tried to outline the book was first we talked about how simple models tend to perform as well or better than experts, to try to give investors some confidence to know that, if they have a simple model and stick to it, they can probably do just as well as a financial expert can do. And then in the second half of the book, we outline from our perspective as money managers the way we would manage money through like an asset allocation framework. So we walk through a couple things. First is, how do you talk about asset allocation? Second is, do you have any risk management rules? And the third is, we're proponents of active investing where we like to focus on value and momentum. So we kind of give a outline as to why we do that and how an investor could follow a model to try to achieve those types of returns.
Yeah, and that's really interesting because one of the simple models that you're doing is that you're testing, I think it's 3 different metrics you're testing in one of the chapters, and that's price to earnings, price to book, and also EBIT to enterprise value. Now, what did you find in when you were looking back? Because you're looking like, I think it was like 50 years back when you were looking back in time. Which result did you find?
Yeah, so what we found is basically, and Wes and I have a paper on this in the Journal of Portfolio Management. It's called A Performance Horse Race Over the Past 40 Years. And the whole question was, everyone or a lot of investors agree that value investing tends to work over a long time. And we said, but what is the best method to use? And there are multiple ones, as you mentioned: book to market, price to book, which is the same, EBIT to TV, free cash flow to enterprise value. So we just tested a swath of them. And what we found was enterprise multiples, or EBIT over total enterprise value, tends to show the largest separation between value stocks, the cheap ones, and glamour or expensive stocks. So what we do in our methodology and in our systems is we tend to screen stocks just on EBIT to EV.
Yeah, so how much are we talking about? Is it like 3%, 4%, beating the market?
So it depends on the methodology. I think if you evaluate, we can get up to about and again, this is annualized, the spread.
Sure.
So the whole idea is we just looked at the spread between value and growth. And I think in our paper it was at least 6%, the difference annualized. Now again, some years growth will definitely outperform value, which we can talk about later, but on average over long cycles, value had the largest spread when using the enterprise multiple.
And you were talking 6%, that was compared to growth, that was not compared to the S&P 500.
That's correct. So it would probably be around 3% compared to S&P.
Okay, and that's not including management fees or rebalancing costs and all that. Is it like pure outperformance?
Yeah. So again, that's outperformance, and then you'd have to take off fees. And obviously, that was just general sorting just on one variable. You could possibly enhance it by, in the book and also in our paper, we have very diluted portfolios. If you went down to smaller number of stocks, you could potentially increase that.
Sure.
But then there's transaction costs, which one has to account for.
Yeah, and that's really interesting. And that's something that we're going to return to. But actually, my next question, that's related to what you said about these simple models. Last weekend, I had the chance to chat with James O'Shaughnessy, who you're probably familiar with. I'm sure in your field, What Works on Wall Street, I guess, is one of the go-to books. And it's a great book, by the way, but it's really this very quantitative approach to investing. And what he's doing in that book is that he's not only looking at, say, price to earnings or price to book. He is composing a valuation metric based on multiple metrics. I think up to 6 different metrics. So he would be, you're probably familiar with this,
Yeah.
but also for our audience, he's looking at price to earnings, price to sales, all of these, and combining them into one to find the most optimal. Have you done a similar study, and can you validate his results?
Yeah, so I would agree in general with his findings, that, averaging across different price measures and making sure, if you just take them in equal weight, if you use 6, each one gets a 6 weight, as long as you're in cheap stocks, you're probably going to do well. And we've done a similar study, found similar results that, combining them works pretty well. The reason we focus just on enterprise multiples is it gives a similar result over the long term compared to the 6 measures combined. And so from our opinion, it's a simpler measure. And then the second reason is, we've done a little internal research. We said, well, why would enterprise multiples work, right? Why would this one measure work a little bit better than other ones on average? And what we tested was, so if enterprise multiples could potentially be used by like a PE firm or someone to buy out a company, right? That's how a lot of private equity would possibly value a firm. And what we found is within the cheapest EBIT enterprise multiple firms, we found a higher propensity of takeouts or mergers compared to other price measures. So I guess long story short is, Jim's measure is good, not disagreeing. We just prefer EBIT to TEV because it's simpler and gets you to a similar area.
Okay, that's cool. And sorry, did you have anything to add?
No.
Yeah. Always feel free to interrupt me. I do talk a lot. My next question is actually about a new concept to a lot of the audience because our audience, they're really like hardcore value investors, really into Warren Buffett, Benjamin Graham, so like this whole philosophy. But very interesting when I also read the blogs that you're posting, and really thank you for writing them, Jag, is that you look into momentum stocks. So perhaps you can start introducing for those that are not familiar with the term. What's a momentum stock?
Yeah, so a momentum stock is, academics have been studying this, and what it is if you sort stocks based on their past price return. So, there's obviously, if you're just going to sort on prices, you have to pick a look back period and then say, okay, well, what happened? So, a long time ago, academics sorted on like long-term price returns, like 60 month. And what you find is if you sort on 60 months, the past winners tend to do poorly and the past losers tend to do well. Well then, FAMA show that's basically value stocks, right? Firms that underperform for long periods of time tend to do better. But what we've talked about when we say momentum is we look at momentum over the past 12 months, and what has been shown in academics, and we found it on our own, is that there's this continuation of returns when you sort stocks on your past 12 months return. So I understand that there are a lot of people that are, if you're a big value guy, because I was as well, Wes is, we were all kind of grounded in that value philosophy, right? The idea of buying a high momentum stock just sounds like ludicrous to a lot of value investors. So, a question is, are these momentum stocks just growth stocks? Because as we just talked about, value stocks outperform growth stocks on average. So why would we then all of a sudden change course and say, now we need to buy these momentum stocks? So what we did is in our book, we looked and we said, okay, what is the overlap between a momentum portfolio and a growth portfolio? And we show it's actually very low. It's around 20% on average. So, basically momentum investing is to sort stocks on their past 12 months return and buy those ones that have done the best. And again, it's not the same as growth investing.
No, and my immediate question would be, so how much have they outperformed momentum stocks?
Like year to date or?
Yeah, I guess it also depends on which time period you're looking at, of course, but Like, are we talking again about, you said 3% with value. Is it more when you're talking about momentum stocks?
Yeah, so momentum stocks, it actually is more. So, again, like if I had to pick one anomaly and go all in, it probably would be momentum if you said I had to pick one for the next 50 years. The issue with momentum is you need to account for transaction costs because this, in general, value, like the stats I told you before for value were when on an annually rebalanced portfolio, which obviously you only transact once a year. The second thing on momentum is we show those stats are on monthly rebalanced. So the further you get out on a momentum portfolio from like 1 month, 2 month, 3 month, once you get out to 6 months, and actually once you get out to a year, you're pretty much the same as the market. So for momentum, it requires turnover, which could potentially mean taxes and stuff. So if you're trying to do a momentum strategy, you need to weigh the costs, which are the high rebalancing, and taxes. One way you could potentially deal with that is through doing like an ETF that does momentum, against the benefits of you get higher returns the more frequent you rebalance.
Yeah, so I think what is it? It's once a month you're rebalancing when it's momentum, and annually if it's value.
So those are the results that we showed in the book.
Mm-hmm.
What I'd say is if someone in practice was going to do this, you could probably do every 2 months or 3 months in momentum and get, you would lose a little expected edge on the strategy. However, you will greatly cut down your rebalance costs. If you go from 1 month to 2 months, you just cut your rebalances in half.
Yeah, because I would really like to talk about these costs because whenever I'm looking up an ETF, it would say something like the turnover cost is 50%, or not the turnover cost, but the turnover ratio would be 25% or 50%, which basically means like how many times are we turning over, and 100% would be the whole portfolio. So what's the turnover ratio normally if you're looking at a value portfolio and also a momentum portfolio?
Yeah, so again, it's definitely going to range from year to year, just because, in a more volatile market, there's going to be more price movements, more turnover. However, in general, on value, if you're doing annually rebalance, it probably can be as low as like 30% to as high as 100%. Depends year to year. Momentum is actually going to be really high. You're probably going to be 150% almost every year, just due to the fact that you're always buying, you're updating your prices fairly quickly, which can have a greater effect on the turnover.
Great answer. And I'm curious, is there any way to say a turnover ratio of 50% is equal to a given number of basis points, just like you would see for a management fee? I know it's harder because you have to account for commissions and spreads, which is not like an exact science, but do you have any rule of thumb when it comes to that?
So on that, I'd say it depends. I mean, that there's actually a lot of stuff that would go in there, because you have to understand what are the positions the portfolio manager is trading, how liquid are they. So for some of our strategies, we tend to focus on like super large liquid names, and if we run a screen and come across a name that tends to be very illiquid, we may just boot that out from the beginning. But I would say, I mean, in today's day and age, all in, if you're talking U.S., it would be anywhere from like 2 to 5 bips per transaction. And again, that's going to range though. It depends because, the smarter you are at trading, you can get that a little bit lower. If you're just doing market orders, you're obviously going to have much larger impacts. And that's kind of the nuances of trading. Which is why, like at our firm, we have 2 traders. That's their full-time job, is to, minimize any trading costs there.
Okay. Yes, and I can definitely say from my own experience when I was working at a trading floor that when you're doing like hundreds and hundreds of trades a day, it's just so different than, as you're saying, putting in one market order, and you might say, well, that really doesn't matter. It's 5 basis points, 7 basis points, whatever it is. But when you're doing hundreds and hundreds a day, it's going to add up for sure.
Yeah, I agree.
So in your study, you're not only looking at value and momentum like side by side. You're also combining them into a portfolio.
hmm
And you're actually even including international stocks, which I find really interesting. So
Yep.
first of all, let's talk about the results. What did you find when you have both value and momentum and international stocks?
Yeah, so first I'll just focus on value and momentum and talk about why we combine them. So one of the nice aspects of value and momentum and why we like to focus on them is obviously in a portfolio context, whenever you're combining different strategies, you would want to have strategies that happen to have like lower correlations, because when you pool them together, right, if one has an edge, like value has an edge and momentum has an edge, pooling them together, all else equal, is good if they have low correlations. And what we found is if you actually run value and momentum in like a market neutral sense, where you create like a long value, cheap expensive, long high momentum, short low momentum, those portfolios are actually negatively correlated. So what that means is, value tends to do well at different times than momentum. So what happens is when you combine value and momentum in a long-only sense, so, any two long-only strategies are going to have a positive correlation just because of beta. But when you pool them together in a long-only sense, what you find is that, you can somewhat lower the deviation of the portfolio, so you get better risk-adjusted returns. And the example I like to give of value momentum is, in the late 90s, value underperformed, just generic value, if you're using like Ken French's data, it underperformed the market for 6 years. However, momentum did very well over that time period, which was the internet bubble. So you'd imagine, you just keep buying more internet names. And then in the crash thereafter, value did very well, whereas momentum was more in line with the market. So our whole idea of pooling these two investing strategies together is you get the benefits of having two value adds, like value and then momentum, and then when you pool them, you get lower standard deviation of the portfolio. And we found the same thing in international securities, where if you combine value and momentum internationally, you tend to get better and a little bit smoother returns. So.
Okay. Yeah, and how would that work? Say that for simplicity, we would just be talking about value and momentum. So would I say that I can put in, say, $1,000 every month, and I want to use the dollar cost averaging, so I would just put in $1,000 every month. Would I then say buy for $1,000 value and then $1,000 momentum, and then just add whatever is has lowest pool of funds the next month, or how would you suggest one go about that?
Yeah, so we're big fans of equal weight.
Okay.
So I'd recommend doing like 50-50. Another strategy one could entail, or one could use, would be to do some sort of like a risk parity weighting, because momentum tends to have a lot higher standard deviation or volatility of the portfolio. So if you wanted to do that, you might have a little bit higher weighting towards value, maybe like a 60-40. But we're fans of equal weight, so we'd probably just recommend like a 50-50. And then as you're putting new money in, you would just keep getting it, so you're staying at 50-50. Because inevitably one asset will, or one strategy will underperform, and in general, if you're putting a little bit more into that, it tends to rebound. So yeah, we'd recommend 50-50.
Okay, and I also think it's a much simpler strategy to apply. Also, the strategy that you're suggesting, that you're doing it based on risk or volatility. Again, that might just be harder if you were like an average investor and had to figure that one out and calculate that. So basically what you're saying is 50-50, whatever is lowest in your portfolio, you would just add to that portfolio.
Yeah, that's you get pretty good returns doing that.
Mm-hmm.
So I'd recommend that to the average investor.
So what about if I want to include international stocks? Like, I don't know if I'm looking at this way too simplistically, but is it like 25% in U.S. momentum and 25% international momentum, and likewise for value, or how do I best diversify and get the best returns?
Yeah. So again, stating point or given where we are, like what do we recommend? We again, we're pretty big fans of equal weight. U.S. international market caps are about 50-50. We're fans of value momentum 50-50. So I think your baseline weights, which you suggested, which were 25% U.S. value, 25 U.S. momentum, and then same international 25 value, 25 momentum, would give you a nice like diversified portfolio where in one year U.S. value may work and one year momentum may work, but in general that's a pretty good recommendation.
One thing that I found really interesting, and this was actually not a question I planned to ask, but I've seen all these interviews with these great investors talking about value investing, and then someone from the audience will always ask, so yes, it might outperform, but now everybody knows that value investing outperforms. Will it continue? And then the investor would say, people have known this for so many years, and no one has really done anything about it. Now, so that's one side of it, and
Yeah.
I definitely agree with that, and it looks to me that you probably also agree with that. I spoke to James Shaughnessy, and he was actually saying a very interesting thing. He was saying if something is really modern to do, something is especially popular in academic circles, you should probably not assume that you can get the same outperformance. And
Mm-hmm.
logically, because more people go into that, and then that premium will disappear. So I have like a two-step question. The first one is, I read your research about EBIT to enterprise value, and I
Yep.
actually read that quite a few places. So the first question would be, do you think that metric will, come under a lot of pressure in the years to come?
Um, I mean, it possibly could, but again, in like if you're talking about like sustainable edge where you have this long-term outperformance of a strategy. So value investing is one example. So when you're talking about like EBIT total enterprise value, yes, people are talking about it more often, but the question is, are the people who really manage the super, super large pools of capital talking about it, right? So I'm talking about like, pension plans that have billions of dollars. Are they all of a sudden going to take their, S&P 500 portfolio and screen on EBIT total enterprise value? Because the only way one of these strategies could go away long term is if enough pools of capital went into it. And from our experience with talking to a lot of, large pension plans and endowments is that, you have this principal agent problem where the person who's managing the money totally understands that value works in the long term. The downside with value is, as we saw in the late 90s and even like this year, so this year value has underperformed a lot. If you had a high conviction value strategy this year, you may lose your job if you're a pension guy, right? So you're managing money for someone else and you say, oh, well, I lost the market by, 5-6% in whatever year. They might just say, well, we're just going to get someone else who's just going to get us the market return. So what we found is with talking with like people who control the large pools of capital, that principal agent problem where the people managing the money, they know these strategies work, but to do them, you need to have super long horizons, like 10, 20 years, which a lot of our investors do. And we flat out tell them, we say, listen, in short run, 1 year, 2 or 3 year periods, we could underperform. And they're like, yeah, we understand this is a long-term game. So, until the super large pools of capital get rid of that principal agent problem, I think we're pretty good to go on value investing.
Yeah, and I think that's really interesting because it's not the knowledge of the fund manager. I guess you can't really find any fund managers that won't say that value investing will outperform, but you can find like plenty of people, and in the end, fund managers, they are investing other people's money, and they'll, as you're saying, just be out of a job. The second part of the question is very similar, and that relates to this concept about momentum stocks. Now, this has also been known for some years. I don't think it's been known for as many years, But
hmm
do you see a trend where from where you're sitting, where more people will start to invest that way?
I think it's possible, but again, one of the issues on momentum is always going to be, um, uh, one is it has even larger tracking error than value. So if you're going to be a big manager trying to all of a sudden go after just momentum returns, you're going to have even larger tracking error. And the second thing is for a lot of taxable investors, the issue becomes taxes, right? So value you can, annually rebalance, sell down losers throughout the year, try your best to minimize tax gains. Whereas I think in momentum, where it's frequently rebalanced, unless you have some sort of tax wrapper to do the trading, and I'm not sure a ton of people um, will be flocking into that strategy.
So, Jack, after following your blog post, and it's also the blog post that Wesley Gray has been writing, I've been thinking, why is it that momentum stocks are doing so well, and why are they perhaps doing even better than value? And one of the things, this is just my theory, so I would actually like to
Yeah.
test you out, is that you can apply this to really big companies without being penalized as you would for value investing, because as you're probably also aware of, small companies usually tend to do better if you test that. But this
Yep.
momentum strategy can actually be applied into really, really big companies, which is even an advantage because you don't pay the same spreads and so on. Would you agree with that?
Yeah, I mean that's what's been shown in the research is that it tends to work across all different segments of the market. So if you want to cut it by size, it works pretty well in small caps, mid caps, and large caps. So I do agree it may be a little bit more or pretty popular just because due to the fact that you can use it within large caps. So
Fantastic, Jack. And then my final question before I have to let you go. Where
sure.
can people find out more about you and perhaps also your book?
Sure. So our firm is Alpha Architect. So just go to alphaarchitect.com. We have our blog, which we tend to update every day. And our book, DIY Financial Advisor, you can actually find on amazon.com. So,
Fantastic.
yeah.
Yeah, so Jack, thank you so much, and I really hope that we stay in touch. This has been so much fun.
Yes, Stig, thank you very much for the opportunity, and hopefully you can come back.